Welcome to Paradigm Shifts, new thinking about our changing times with your host, Harriette M. Steinberg, practicing matrimonial and family law, real estate, trust and estates, and elder law. You can watch episodes on YouTube and listen through Apple Podcasts, Spotify, Google Podcasts, Stitcher, and more. For prior episodes, go to www.lawyersonli.com. Now here's the host of Paradigm Shifts, Harriette Steinberg.
Securities and advisory services offered through Royal Alliance Associates, Inc., RAA, member FINRA, SIPC. RAA is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of RAA. The main office address is 575 Broad Hollow Road, Melville, New York, 11747. You can reach Bruce at 631-465-9090, extension 5019, or by email at bruce@birnbaumadvisory.com.
Hi.
Good morning. How are you?
Welcome to another episode of Paradigm Shifts. I'm Harriette Steinberg, also known as the Divorce Sherpa. I'm an attorney, and for the last 40 years or so, I've been practicing matrimonial law, elder law, trusts and estates, and estate planning. My process of choice when working with clients is mediation and collaborative practice. And so, in each episode of Paradigm Shifts, you will hear from a professional who has an important message to share about lifestyle change. We'll be discussing divorce, aging, death, retirement, financial issues, and more. And so today it is my pleasure to introduce Bruce Birnbaum, financial advisor extraordinaire. And I would say to everyone, pay attention. You will definitely learn something. Good morning, Bruce.
Good morning, Harriet. It's so great to see you and talk with you this morning. It's a beautiful morning outside.
Yeah. So we have a lot to cover. And I'm going to start with asking you probably the question you get asked an awful lot. What is the biggest mistake that you see clients making in their financial estate and planning issues?
Well, first of all, thank you so much for inviting me to join you this morning. I will say that is a difficult question to answer because there are so many mistakes that people do make, even very, very smart people that may not have too much familiarity with some of the financial issues. I would say, I'm just going to pick some, like a random thing as an example. But when I review people's scenarios, we do see lots and lots of mistakes and issues. One of the big ones is mistakes with respect to beneficiary designations. So a beneficiary designation is typically used in a qualified account like an IRA or a 401k, a profit sharing plan, 403b, SEP IRA, and even beneficiary designations are used with life insurance and annuities. And essentially a beneficiary designation determines who gets the asset when the owner dies, in what percentage, and in what manner. How do they receive it? And we see big mistakes there very frequently. So one example could be someone goes to a lawyer, has the best will prepared, the best trust prepared, but never coordinates the beneficiary designations with the will or the trust. And even when an excellent lawyer does help the client make that coordination with the will or trust and their assets, it could be that sometime after the will is done, a year or two later, a client transfers money to a different account or opens up a new account and never coordinates that one with the will, and then all of the benefits of this marvelous document are lost. And it could be expensive to the beneficiary. I mean, they could lose, tens of thousands, hundreds of thousands of dollars or more. I have so many examples of that. Recently, yes.
I just want to emphasize this is a paradigm shift because beneficiary designations aren't always written in stone. Life changes, right? And keeping that in mind is something that can save grief.
Oh my gosh. I think that's actually, the life changes concept is so critical because what somebody thought was a good way to leave assets year one may be vastly different by year three.
Right.
I recently saw this in the context of a second marriage. The client, in a related way, the client had a prenuptial agreement. However, a couple of years after the prenup was drawn, and I'm assuming the prenup determines what happens to assets in the event a married couple eventually divorces, they opened up an account that essentially bypassed the prenup inadvertently, and they did get divorced, and it cost the client that was very recently referred to me actually well over $1 million just because of that mistake. So I like that phrase, paradigm shift. I think it's great because his entire perspective changed. So we have so many examples of mistakes with beneficiary designations, which is really important. We see it a lot. Sometimes somebody might have a qualified account, like a 401k plan, an employer-sponsored retirement plan, have a will that creates a trust for young children, but they may name the children directly in that document, and they can have hundreds of thousands of dollars or more in these plans that wind up not going according to the methodology that was chosen in the will or the trust. So many mistakes we see. I'm not going to list them all, but we'll start there.
Okay, but when clients come to you, going to a financial advisor, what are their concerns? How do they come to you, or what are they coming to you for? Let me ask it that way.
Yeah.
Okay?
So you're asking great questions, and they're actually very broad-based questions because there are so many different concerns. But I will say, so I will pick and choose. So one concern has to do with retirement. Big issue. Many people come to me before retirement or at the very beginning or even during retirement. And one of the biggest concerns is, will they have enough money during this time period to last their lifetime? And that's especially magnified during this time with this market downturn that's occurring now. And maybe we'll have a chance to address that in a bit of time. Maybe I'll save that for later. But one of the ways that I help clients make smarter decisions about their money is I can project, and I do project, their cash flow from now through the age they think they're going to live until, and we have a lot of conversation about that, and show them how well their money will last, or show some kind of adjustments that can be made to help them make their money last. So that's one concern. That's a big concern, having money last. Another question related to that is how can they spend their money? And I'm sticking with retirement. So can they buy vacation homes? Can they make home renovations? How much can they spend on vacation during retirement? How much can they gift to children or grandchildren before it starts really impeding on their own enjoyment of their life and expenses? So those are issues.
You know what I say, the best grandparent rule is keep your mouth shut and your pocketbook open, right? So you tell us how open we can keep it. Is that it?
Oh my God. You're making me laugh.
No. Okay, I'm sorry.
But it's true. Yeah. Well, yeah, but concern. How should a grandparent deal? That's a whole nother thing. Another issue has to do with IRAs and Roth IRAs. And there are also even, it's a related topic with respect to retirement accounts, because you can have a retirement account that's traditional versus Roth. So I'll explain. So, and I'll just do it by explaining the difference between IRAs and Roths. But questions that I do hear from clients may relate to whether they should open up a traditional IRA versus a Roth. With a traditional IRA, they get a tax deduction for the contribution going in. The money grows, tax deferred, but eventually they have to start pulling the money out, and the money that they pull out is subject to income taxes, which reduces the benefit. And they have to pull out this money over the course of their lifetime, known as required minimum distribution rules. With a Roth IRA, they can make a contribution, but not get a tax deduction, but the money grows tax-free. They actually never have to pull the money out. And when they do pull the money out, it comes out tax-free. So it can actually be a better way of building wealth than the traditional IRA. And it also is a more effective way of leaving money to children or grandchildren, as an example. It's a better legacy asset. Even with employer plans like 401ks or 401ks, I'll stick there. Many employers offer a traditional 401k or a Roth 401k. So we often will show a client side by side, which, we'll show the two of them so that they can see which way works better for them. Related to that is whether it makes sense for someone to do a Roth IRA conversion. So there, somebody might have an IRA, and sometimes the balances are pretty large. They can convert it to a Roth, meaning they would transfer the money in their IRA to a Roth IRA. That conversion is subject to income tax. So we would do an analysis of whether they're better off doing the Roth IRA conversion or not. As a general rule, it takes several years for the client to be better off because they've paid the income tax up front. So that's a very versus.
But when you were saying that, what occurred to me is, again, the grandparent rule. If you're converting your IRA and going to leave it to grandchildren, it might be better. I don't know. It might be better to give them tax-free income over a period of time. Correct?
You're right. Exactly. You're exactly. Yeah. As a general rule, it takes about, I'm just going to say around 10 years-ish for the taxpayer to be better off having done the conversion. It takes about that long, in many scenarios, for the benefits of the tax-free nature of the Roth IRA to overcome the fact that they had to pay all of that tax when they did the conversion. But I agree with you. It's a powerful way of leaving assets because then a child or grandchild can pull the money out income tax free, which is quite a big difference.
So do you get questions about Social Security benefits? People coming to you?
Yeah, it's so funny that you asked that because it's definitely in the list of concerns, and it even goes back to biggest mistakes that people make. But often we will illustrate for someone when is the best time to take Social Security benefits. Because Social Security can amount to so much money over time, it's pretty important to have that evaluated, you know, because if somebody makes a mistake, for example, taking it too early, they're essentially forever penalized with a reduced benefit amount. On the other hand, if they delay taking Social Security benefits, their income can go up dramatically. There's a concept known as full retirement age. That's when you are entitled to 100% of your Social Security benefits. If you take it before that age, there's a forever reduction in the benefit. On the other hand, if you take it after that age and you wait until age 70, you can delay it right until age 70, you get delay credits. When you do the delay credits, it increases your income by about 8% each year. So your income is, so that sounds like a no-brainer to delay it, except there's one thing. Because you essentially let a few years go by without taking your benefit by delaying, when you delay, you have to live long enough for that delay to have made sense. Right. So it's a very simple decision. All you have to know is the date you're going to die. And then it's simple. Easy.
Well, I thought you'd give us that guarantee as the financial advisor. That doesn't come with the.
I haven't taken that course yet, but I'm going to look into it. But essentially, if you do delay Social Security, you have to live, a certain number of years, approximately at least 10 years for it to have made sense. So you have to figure you're going to live at least to age 80 and preferably beyond age 80 for it to make sense. But that's a big issue. The law changed as of May 2016 with respect to options with Social Security. So it's especially important to have somebody, do an evaluation for the timing of Social Security. And what we do typically when we do financial planning or what I call consultative planning, and I'll explain the two maybe later, we will show side by side the impact of taking it at different ages so somebody can make a smarter decision about the timing.
Right. So I bet your phone has been ringing off the hook with my next question, which is, Bruce, the market, it's going down. What am I going to do?
Yes.
Let's do something. Help me. So
yeah. So
what do you do?
Yeah. So I have not had panic phone calls. I have been in touch with my clients, but there's no question that the market downturn that's happening now is of great concern. I could list all of the reasons why it's occurring. And, you can have 10 economists in a room giving 10 different explanations, and they all make sense. But right now, there are
like 10 lawyers in a room giving you an opinion, right?
It's kind of like that. But right now you have high inflation, high energy costs, supply chain issues. I mean, it's a conglomeration of problems that has really negatively impacted the market. And this is especially concerning for somebody who's getting close to retirement or in retirement and needing to pull money out of their accounts for income when the market is going down. So there are a couple of strategies that we use in our practice. One I'm going to refer to as a layered income strategy. And at a very basic level, I can simply say that we will help a client earmark certain groups of assets. And perhaps group one would be the assets that they would use to take income from years 1 to 2. Then second group might be assets that they would take income from years 2 to 4, and then the next 5 to 10, and so on, and have each of those groups invested in a different way to help buffer against these market downturns. Another thing that's really popular with respect to protecting income when the market is in a downturn are the use of annuities that provide guaranteed income. It's a pretty controversial area because they are somewhat complex financial instruments, and there are insurance charges within them. So the upsides and the downsides have to be weighed very, very carefully and explained extremely well to a client. But we can help someone, make again an intelligent decision about whether it's appropriate for them.
Wow. In terms of estate planning issues, are you called upon to deal with some of the changes that are occurring as they occur?
Yes, it's like it's a moving target. So while I don't practice law any longer, my background is in the law, and I have a law degree. I have a master's of law in taxation, but I don't practice. Here, if legal work needs to be done, I would be referring them to an attorney like yourself. But I do work closely with my clients in this area, and keeping myself very apprised of these issues because the estate planning is inherently part of a financial plan in almost every scenario. Right from the beginning of our discussion today, we talked about beneficiary designations, which is related to estate planning. So I do get very involved in reviewing the estate plan for a client, helping them evaluate the best way to leave assets, whether it's in trust or otherwise, helping them evaluate ways to minimize income taxes and estate taxes, whole host of issues. It's an enormous topic, but I spend a lot of time helping clients with that and am able to work well with their other advisors, like their attorneys, et cetera, in helping really construct a smart, effective, efficient estate plan that's flexible enough to change over time as the laws change. The laws are constantly changing, and sometimes in unanticipated ways. One example is there was a change in the way people receive inherited IRAs. I'll use that as an example. Here, if somebody had an IRA and passed away and left an IRA to a non-spouse, like to a child or someone else, the beneficiary used to be able to take the IRA and take withdrawals over their lifetime. The law changed, and now they have to take it within 10 years. And that's what people, many advisors and lawyers and accountants thought was the rule. However, now the IRS is clarifying that rule and essentially looking to have required forced distributions from that account during the 10 years. So it's revamping how advisors are helping clients with these scenarios. And there are a number of strategies that we're using to help cope with those changes.
Right. That's important. What about long-term care? How are you approach clients that must be calling you about that?
Yeah, I have clients calling me. I have lawyers and accountants often calling me to help their clients with those issues. I call it a subcategory of estate planning, long-term care, because you have a great estate plan, but if you, your spouse, or other loved one needs care, the cost can be exorbitant. And the cost of home care or assisted living facility care or nursing facility care can really, I'll just simply say, negatively impact one's finances and really change the course of somebody's anticipated retirement, emotionally, health-wise, and financial. So we will often, illustrate for someone in the financial planning the costs that might be incurred and show them different ways of coping with the costs. There are insurance products that we help clients evaluate, and we can really show them in detail. But for some clients that may not have enough money to do the insurance, might not have the health to get the insurance, or might have an inclination against the insurance. There are trust and estate strategies, of which I know you are extraordinarily well versed in. And, so setting up trusts or other plans might be appropriate, but we'll really help a client evaluate that and work with their other advisors in that realm.
So tell me, when's the best time to do a financial plan?
So I have clients from, age 30 to age 95. Actually, yeah, I guess that's about the range. So
95. Wow.
it's not my oldest client as I really think about it. But I would say when certain life events occur, that usually indicates that it could be a good idea to do a financial plan or consultative plan. The difference between the two is a financial plan is usually more comprehensive in that it addresses many more topics.
Right.
Cash flow, tax planning, asset allocation. It's just a much more broad approach. Consultative planning could be effective if somebody has more specific questions. If their concern is just in the retirement domain, or in the tax domain, or in the estate planning domain, then we could just hone in a little more specifically with a consultative plan. So I would say when life events occur, those are indicators. So if you have a couple in their 30s with a new baby, that might be an indication that they should look to have a plan that at least evaluates things like whether they should have insurance, how much insurance, how their insurance should be owned, looking at an estate plan even at that young age, because now there are children where you might want to select guardians and trustees. So we'll help the client with that and work with their attorney to really help them get started in the right way. Very often the last thing people think about, when they have a young child is doing the estate plan, but it's pretty important if you think about it. Then as people get older, whether they're in their 40s or 50s, their priorities change. It may be, again, cash flow, budgeting, vacations, life enjoyment, starting to save. How much can they save? So a whole host of issues. As people age, they start focusing more on retirement planning, estate planning issues, long-term care issues, all of the things we've been talking about. So I would say usually if a financial question crosses someone's mind, it's usually an indicator that it may be a good idea to look to have a financial or estate plan.
I have the perfect answer for that question. From now on, Bruce, just say whenever you have a paradigm shift in your life, right? That really is the essence.
Unfortunately, when you said that, it hit a nerve, because it's not always good things that cause the paradigm shift. Their life throws curveballs. And I work with people, as I know you do, that have had curveballs thrown at them. And sometimes they are real challenges, whether they're financial, health related, interpersonal, relationship issues.
Sure. Yeah.
Right. So those are all, I'm going to use your expression, paradigm shifts, that would indicate certainly wanting to seek out advice from professionals.
Yeah. So now, one of the most important questions, which we're saving to the end, okay? But tell me, Bruce, how do clients work with you? What kinds of arrangements? I don't expect you to give me minute details, but tell
I am a detail person. So first and foremost, we act as fiduciaries. That phrase, fiduciaries, has become very in vogue, but we've been operating as fiduciaries for decades. at this point. So that's not, a new thing for us. But what that essentially means, if I boil it down, is that we review, evaluate, and make recommendations for the people we work with in their best interests, not in our best interests. That's like the clearest example. That's even if it's insurance, whatever they're looking to do, we're looking from their perspective, not our compensation. That's the last thing. It's also not how I'm built. So we may charge a fee depending on the extensiveness of the work, but our original consultations are never for a free. We find out a bit about someone. We may discuss a fee if the work is going to be, somewhat more extensive, and they would never be charged a fee unless they agreed to it and then sign an agreement, for the fee, and then we would move forward. One of the things I can say about the way we work and our practice, it is the opposite of a transactional practice. It's definitely more of a trusted advisor relationship. I have clients for 5, 10, 15, 20, and over 20 years. I know my clients really well. I know what drives them. I understand them. I know about their family dynamics, their interpersonal relationships. And I would say I've developed over the years very strong skills to put myself in their shoes, to see things from their perspective and have their judgments and values drive their decision making. If they're going to do something that is kind of very costly, I'll certainly explain it to them, and show them how there may be a better way. But ultimately, their decisions control. I do have a client who said to me a few years ago, and I really like it, and I do repeat this to clients. When we were doing a financial plan, he said, "Bruce, I want to reserve the right to be stupid."
Yeah.
But he was really—
He wants to be educated but stupid.
Right. He was really just expressing that he wants control over his decision making. That's really what it was. And the reality is he's extraordinarily bright, very sharp gentleman who has done very well in life. And he's never actually acted stupid in any of his financial decision making since I've been working with him, notwithstanding his remark. But, I would say, I don't know if this is what you were driving at with your question, but I love talking with people and helping them accomplish the things that are important to them, and the people and helping, them with the people they care about. That's the driving force behind why and how I get so connected with the people I work with and why I love what I do. So
tell me, last question. How do we get in touch with you? What's the best way?
I do have a website, birnbaumadvisory.com.
Okay.
The best way to reach me is actually these days by my cell phone as opposed to my office phone. Although I am in my office, but my cell is— should I give my—
Yes, give us your cell phone number.
516-313-6649. And my email is bruce@birnbaumadvisory.com.
Terrific. Bruce, I really have been, as usual, I really have enjoyed speaking with you. I know we could continue and go on, and perhaps you'll come back and we'll drill down on one of these. But thank you.
Each of these topics is a topic unto itself. Harriet, I agree. I enjoyed talking to you so much. Thank you so much for today.
Bye.
Thank you for listening to Paradigm Shifts, new thinking about our changing times with your host, Harriette M. Steinberg, practicing matrimonial and family law, real estate, trust and estates, and elder law. You can watch episodes on YouTube and listen to Apple Podcasts, Spotify, Google Podcasts, Stitcher, and more. For prior episodes, go to www.lawyersonli.com.